Hey everyone, thank you for joining us for an update on the V-List performance and strategy for January 2025. My name is Darryl McCoubrey. I'm VP and Senior Analyst with a focus on energy and pipelines. Today I'm joined by Martin Pradier. He's our investment analyst in materials. Uh, as before, just in these videos, we like to go through a brief kind of explanation of what the V-List is. We have a tagline, a list of golfing stocks. It's generally because we're looking for lower risk stories. It's a model portfolio of the top buy ideas of our team, our independent analysts. Bottom up fundamentals drive our picks. One of the things I think that's a niche, a nuance, if you will, of our approach is we tend to focus a lot on accounting and disclosure. That really goes into the idea of understanding business fundamentals because we found through experience that sometimes non-GAAP metrics can mislead you on what fundamentals might actually be. It's an equal weighted portfolio, 12 to 25 names, relatively low turnover and sector agnostic. And if unless returns are really, really appealing, we tend to prefer larger cap and liquid names simply because they're liquid. Specifically, our process when it comes to individual stocks, it's at the core, it's the analysis that our independent analysts provide to us. But then on top of that, we do a comparison of all the different ideas, best ideas that we would have in the case of the V-List. And then we'll action changes based on our assessment of risk across those ideas and kind of marry that thought with whatever returns that our independent analysts expect from each stock. This is just a photo of our great team that writes all this research and has helped us outperform over the years. We believe that independent research helps out performance over the long term. And it's a priority here that we hire the best people and we train them to be independent analysts. They kind of follow our process of highlighting accounting and disclosure differences and then also taking a pretty candid perspective when it comes to risk. Typically, getting a 15% year-to-date, one-year return, calendar 2024, it isn't so bad, but last year was a great year for stocks in general in Canada. So we underperformed the index. As we look forward, though, we haven't changed our strategy. I think a lot of the alpha that we missed is more on the riskier side in terms of assuming a lot more growth potentially. And we're still pretty confident with the names that we have today. That we'll be able to ride out whatever uncertainties will play out over the next 12 months. One of the, I guess, shining lights amongst our coverage last year, something that helped our performance significantly, was the great research that Martin's done, not just on precious metals, but on materials in general. We have him here today just to explain some of the core elements he looks for when picking gold stocks. And so, Martin, maybe if you could just briefly go over that abridged version.
Okay, thank you, Darryl. And so when I'm thinking about gold stocks, one of the things that is very important is cost, because in general, miners that control cost tend to outperform. You can also mitigate the risk with streamers, especially with wheat and precious metals, which trades very much like gold, but with some upside to gold. I mean, has beaten gold and miners in the last 5 years handily. But the other thing that I look is valuation, because obviously, if things are very expensive, it's difficult to outperform. In terms of gold, we see a good environment. It's not going to go up 30% last year, but I still think that it can go up a single digit. There is a lot of geopolitical uncertainty, and gold is the best way to make sure that doesn't hit your portfolio. There is a large U.S. budget deficit. The central banks, especially China, are buying gold. And the Chinese consumers that were hurt by the real estate crisis are buying a lot of gold. So on the supply side, there is a lot of good things happening. In terms of the mining stocks in general, they haven't go up as much as gold, and they have a lot of earning momentum. So gold prices were around 2,100 in Q1 last year, and now is about 2,700. So when they report, they will have a lot of earnings improvement. Gold miners have usually 2-to-1 leverage. So if gold price go 10%, gold miners, if they are able to maintain costs, should increase earnings about 20%. So cash is improving. Some of them are doing share buybacks. We are very positive about gold names.
Okay, thank you very much, Martin. That's outstanding. And I think it's a pretty good segue into the next slide. This illustrates how we truly are sector agnostic, how we rely on our research analysts like Martin, who bring us great investment opportunities like he was able to find last year in the gold space, kind of showing you the sectors that we're overweight and underweight. Don't take this to necessarily mean that we're more optimistic or bearish on individual sectors. We tend to focus on what are the best names within each sector and what names are likely to provide the best risk-adjusted returns based on the research that we've done. For more of a trend view on where our allocation has come, you can see that as the market was taking a bit more of a risk-on approach, we were slowly taking a bit more risk as well. Having said that, looking at our portfolio today, we're still relatively tilted towards defensive stocks. And not just that, we're always mindful of issues that could be catch investors unaware, things like tariffs, for instance. Those are the sort of things that we definitely try to, we can't make our portfolio immune, but we try to make it more resilient. And with that, I think I'll close it out. It was great to get a chance to chat with everyone again, and hope to see you next quarter, and we'll update on performance then. Bye for now.